let's just pick up there with that big news from Tencent. As Emily pointed out, the biggest corporate debt deal so far this year. Sign of the times? What does it mean for the broader market?
I think it actually underscores two important points here. The first is the overall demand for credit, and within that, higher quality credit. And the second is, even in an Asian context, the demand for good quality Asian names is still pretty intact. So if we look through the last few months, we had record issuance in the US investment grade credit, but we didn't have as much of issuance post the emergence of COVID in Asia. We're starting to see that change with the better quality names in Asia have come to the market and are very well received. So overall, I wouldn't say that it's a market beater rally. I wouldn't say that we are out of the woods, but clearly the demand for good quality credit is intact.
Okay, and it does seem as though we see more money chasing these good quality names, and that makes me wonder, is it getting harder to find bargains in this environment? I mean, are you still satisfied with the price that's being offered?
So I think it has obviously moved a lot since March 23rd announcement from the Fed and then April 9th announcement after that. The credit markets have come in a lot. I would say covered at least 60% of the losses in March. There's still value in the market. When you think about where the rates are and where you expect the rates to be in the coming 1 or 2 years, where are you going to get your yield? Where do you find income? So credit is actually going to be a mainstream asset for a lot of investors I can think of. But the key here is you've gone away from, to some extent, the pure market beta rally to much more looking for alpha, much more looking at the security selection, much more looking at case by case rather than trying to go long the market.
Right. Neeraj, but an important aspect there is interest payments, right, on that yield. And if companies are facing a slowdown, if revenues are feeling the pinch, then all of that translates into how they honor the commitments they've made via these bond issuances. Isn't that a worry as an investor?
That is a worry. As we have seen the turn in the credit cycle, we do expect the default rates to pick up. But the key here is, again, differentiation in credit based on countries, sectors, as well as the idiosyncratic risk and specifically credit. So I don't think it's a broad-based issue you would have, but the security selection, looking at the leverage, liquidity, and cash flows of these corporate issuers is becoming much more important. Hence, you have to pick and choose where you actually invest in the light of higher default rate expectations in the next 12 to 24 months.